Hello, and welcome to another Taxpayer Clinic public service announcement. This video is brought to you by the student attorneys at the Tax Clinic at the South Texas College of Law, Houston. Today, we will be going over the common but sometimes complex struggle of withdrawing money from your retirement accounts. Do you have a retirement account but don't really know how to withdraw money from it? Do you find the whole concept of retirement accounts to be confusing? Or maybe you're just curious as to how it all works. Well, we here at the Tax Clinic are going to take you through a crash course of the most common retirement accounts and to show you how you can navigate withdrawing from them without receiving a penalty. But first, our tax clinic is located in downtown Houston at the South Texas College of Law, Houston. Our address is 1303 San Jacinto Street, Houston, Texas 77002. You can contact us at 1-800-646-1253 and set up an appointment with one of us about any tax question you may have. Now, the four most common retirement accounts are profit sharing plans, 401k, 403b, and the IRAs. 401ks, 403bs, and profit sharing are all plans within the same sort of family. The main difference between these three is that the profit sharing plans are solely contributed by your employer. 401ks and 403bs are plans that include both your employer's contribution and your own contribution through a salary deferral. In this family, all contributions are tax-free as they accumulate in your account, but distributions are taxed upon withdrawal.
There are two types of individual retirement accounts, or IRAs, traditional and Roth. For a traditional IRA, the money is contributed before being taxed, meaning you only pay taxes when you withdraw from the account. Your tax rate for a traditional IRA is based on your tax rate at the time you withdraw from the account. For a Roth IRA, you pay the taxes before making the contributions to your account. This means you don't pay taxes on a Roth IRA when you withdraw from it. Next, we will discuss withholdings. Because most retirement plans are not taxed until you withdraw from them, you will want to fill out a W-4P to inform the IRS on how much should be withheld from your account in order to cover any tax liabilities. This is similar to the W-4 you'll fill out when starting a new job. Because a Roth IRA is taxed beforehand, you will not need a W-4P for your Roth IRA account. Because these accounts are meant for retirement, there are penalties that may occur. First, if you withdraw from the account before the age 59 and a half, there will be a 10% penalty on the taxable amount. Second, if the account has not been opened for more than 2 years, there is a 25% penalty on the taxable amount. There are exceptions to these penalties, such as death, disability, and medical expenses, and for IRAs, first-time home purchases within 2 years of the account being open, health insurance premiums while unemployed, and higher education expenses.
These are the documents that indicate that you have a current balance in and/or have withdrawn from a retirement account. You will receive a Form 1099-R when you withdraw funds from a retirement account. This will come from either your employer or the bank or financial institution that you have the retirement account through. Use the 1099-R to report your withdrawn amount on your tax return for the year of withdrawal. You may also receive a 5498, which is simply a notice of the amount in the account or accounts and you keep the copy that is sent to you in your financial records. You do not need to report or file this on your tax return. For the most common retirement accounts, the money put in is not taxed until it is taken out of the account. Retirement accounts accrue interest while aging, so you often end up with more money available to be withdrawn than you initially put in. Because you deduct the amount that you put in when you file your yearly taxes, the distributions are 100% taxable, including the interest. As discussed before, there are penalties for early withdrawals, and they are imposed when you file your tax return, meaning your tax refund could possibly take a major hit from withdrawing early. 70.5 is when you have to start pulling out a required minimum distribution amount, or RMD. You must withdraw the minimum amount by December 31st of every calendar year. Depending on the retirement plan, you may be able to delay paying the RMD until April 1st of the following year after you turn 70.5. The RMD is calculated using a uniform life expectancy table like the one pictured here in the video. Using this chart, you take the applicable divisor associated with your current age and the total amount held in your retirement account at the end of the tax year, and use the equation shown to determine your required minimum distribution, meaning the minimum amount of money that you must withdraw from your retirement account for that year. Here's what you can do now. Talk to your employer about setting up the best retirement plan for you and your family's needs. Think before you withdraw. Even though you may need the money right now, the penalties could be overwhelming in the long run. And know what to take out and when by calculating and planning the correct amounts that you must withdraw. The most important thing you can do is start contributing to your retirement account as soon as possible to reap the most benefits down the road.
This has been Raquel Cabrera,
Joseph Hartman,
and Rachel Jordan from the South Texas College of Law Low Income Taxpayer Clinic. Thank you for taking the time to learn about withdrawing money from your retirement account. We hope that we provided you with the information you needed. Feel free to call us if you have any additional questions or visit the IRS website at www.irs.gov.